Hello, everyone. Good afternoon or morning, depending on where you're dialing in from. I'm Brittany Melville with Next Generation. For anyone who's joined our webinars in the past, you've probably seen my face or heard my voice. Today, we're going to be focused on a bit of a unique topic we have not covered in quite a while. Most of you are used to us talking about self-directed IRAs and more straight retirement accounts that can be invested in alternative assets. But today we're going to talk about HSAs, health savings accounts. And a little known fact to many is that they can also be self-directed, and the funds that are contributed to HSAs can be strategically invested to accelerate the growth of those accounts, and they can actually be used as sort of another alternative type of account for retirement savings, which many people don't realize. So I'm going to talk to you about that today. The webinar is being recorded. If you weren't able to join for whatever reason live, we will send you a copy of the recording. And if you have any questions, there should be a chat or question tab on the right side of your screen. So feel free to pop those in. It's just me and you guys today, so I'll try to check those periodically. But this shouldn't take the full hour. We're just going to talk about HSAs and some of the things you can do with them, and I'd love to hear your questions. So with that, we're going to just jump right in. I think most of you know Next Generation's role as it relates to self-directed accounts. For any of you who are joining for the first time, we are a custodian and administrator, meaning that we hold these types of accounts, and then we do all of the required tax reporting, record keeping, documentation, provide all the customer service and transaction processing related to the accounts. We're very focused on education because we are not a bank and we're not financial advisors. So that leads me to the disclaimer that we do not provide financial advice, as we are not fiduciaries, nor do we endorse or recommend specific investments or provide any legal advice. But we do have a network of contacts in different specialties and other financial professional arenas that our clients have used for those services. So if it's necessary for you to get legal advice or financial advice related to one of these investments or having a self-directed account, you can certainly do that. But today's webinar is going to be for educational purposes only, and we as a custodian act as a neutral third party in terms of managing the account. So first, I think most people are familiar with HSAs. You've certainly heard of them, and I think most people know that they stand for health savings account. But what essentially is it? So it's a tax-exempt account, and it has to be set up with a qualified trustee. And in this case, Next Generation would be the trustee of the HSA. And it's designed to pay or reimburse certain medical expenses. In many cases, they're used to cover medical expenses. And what I think most people think of when they have an HSA is, oh, this is just sort of like a piggy bank. So I'm just going to put money in here and I'm going to let it sit like a savings account, right? The word savings is literally in the name. But I think what most people don't realize is that you can do more with the money that's sitting in there rather than just have it operate like a savings account, which isn't really going to earn you much over a long period of time. So if you're willing to take on a bit of risk, you can choose to self-direct your HSA funds, and you can put them into some alternative investments as part of your, one component of your health building strategy. So how do you qualify for an HSA? You have to be covered under a high deductible health plan. About half of employers these days are offering these as part of health benefits. And a high deductible health plan is defined as, or one of the criteria is having a minimum deductible of $1,400 per year for an individual and $2,800 for a family. Health savings accounts cannot be set up for someone who's enrolled in Medicare or other medical savings plans, or anyone who's claimed as a dependent on another person's tax return. If that person had an HSA, the dependent could be included on the family plan, but they couldn't have their own separate if they were claimed as a dependent. So I mean, it's very common today for people to have high deductible health plans, higher out-of-pocket maximums as well and slightly lower premiums, right? And I think that what most people think about today is if they don't anticipate to need lots of health care, if they're maybe in their younger years and they have not reached the age of retirement, they don't have a lot of health issues, they say, hey, I'm only going to spend what I need as I incur healthcare services. So it does tend to be more common these days with those lower, more manageable premiums. So how do you fund an HSA, right? Well, certainly an employer who's sponsoring one could make a payroll deduction from your paycheck and put some of those funds into the HSA for you, in which case that does not count toward your taxable income. You could also deposit your own personal funds into an account. For 2021, the contribution limits are pretty generous. It's $3,650 if you have individual coverage. It's $7,300 if you have family coverage. And if you're over the age of 55, you can pop in an extra $1,000 per year, which we call catch-up contributions. You can also, and most people don't know this, have multiple HSAs. You can transfer funds between them. So you may choose to use one to cover medical expenses or medical emergencies, and then you may have a second one, for example, a self-directed HSA, as another wealth building tool for long-term investments or other future medical expenses, or you can use it to supplement your retirement income. I think we all know that the cost of healthcare has continued to rise. It has become difficult to manage for many. And today's workforce is expected to need at least $250,000 to cover medical expenses during retirement. So having a self-directed HSA as another option can be helpful. Another thing to note is you can contribute up to the maximum regardless of your income. So unlike Roth IRAs and some other types of accounts that limit your contributions, regardless of whether you even have any reportable income, you can continue to make those full contributions that are listed here. And then your entire contribution is tax deductible, which is another great benefit. You can contribute in years when you have no income, as I had mentioned, and then even if you're self-employed, you can contribute. So there's a lot of flexibility with HSAs. So here's where you see the real benefit of the HSA, which you're not going to get with any other type of retirement account. At least not all three, right? So contributions, as I just said, to an HSA are tax deductible. The earnings grow tax-free, and I apologize, there's a lawnmower outside, so hopefully that's not drowning out my voice here. Work from home life. So all the earnings in your HSA grow tax-free, and then any funds you withdraw for qualified medical expenses are also tax-free. So, I mean, that's pretty powerful in terms of tax savings all the way around. There are lots of expenses that qualify as approved, if you will, medical expenses. Some of them are listed here, but you can see the link below, hsacenter.com. And even if you just look up qualified medical expenses and HSAs, you'll find there's a full list. Some of the interesting ones include, like as we see here, therapy, special education, things that people probably didn't think of. I think we mostly assume dental and vision, insurance premiums. Home and long-term care, also a pretty important one, as we may have, want to save for ourselves as we age to cover our own long-term care, or those for our loved ones as well. So qualified medical expenses would have to be incurred by either you and your spouse that's covered on the plan, or all dependents you claim on your tax return. So those are the individuals that would qualify to have you withdraw medical expenses and have them remain tax-free. Another thing to note is if you're no longer an HSA eligible individual, you can still receive the tax-free distributions to pay or reimburse for your medical expenses. So for example, let's say you qualify for a high deductible health plan now, and over the next 5 years, you maintain that plan and you continue to make contributions and you invest the money, and then you you're auto-enrolled in Medicare and you can no longer qualify. That's okay. You can still take those tax-free distributions once the funds have already been, deposited into your account. So some pretty powerful advantages here. A couple other things that are interesting about HSAs, and this is one of the reasons why many say that they can be used as essentially supplemental retirement accounts, that after the age of 65, you can almost use your HSA like it's a traditional IRA. So even if you wanted to withdraw funds for non-medical expenses, you can do so without a penalty after age 65. Of course, at that point, note that you're going to have to pay income tax if they're not qualified medical expenses, but that would be the same thing as pulling money out of a traditional IRA. And unlike traditional IRAs, there are no required minimum distributions. So you can hold those funds in the HSA as long as you'd like. Even past the age of 72, the IRS is not going to require you to start taking money out. So again, other things to note, other pretty powerful features here. So when we talk about, now we understand how to qualify for one, how to fund one. If you have one elsewhere, you can transfer money from that HSA into a self-directed one to get started, or you can make your own personal contributions out of pocket. If you'd like to invest in alternative assets with your HSA, these are some of the things that you can do. If you already have a self-directed IRA with Next Generation or another company, you're probably more familiar with how this works. Just keep in mind that then the same investment options you have in your current self-directed IRA are also going to apply to your HSA. So you can do a lot of different things: real estate, private equity, lending, cryptocurrency, get into social and impact investing. Again, the only restrictions the IRS puts forth are you cannot invest in life insurance and collectibles with a self-directed account. And for anyone who's a little bit new to this, important to know that there are certain restrictions the IRS does have in the code, their definition of what they consider prohibited transactions, which is defined as an improper transaction between an IRA and a disqualified person. So I will define what a disqualified person is on the next slide real quick. So disqualified persons from the self-directed HSA, for example, would be yourself personally, any spouse, ascendants, descendants, and their spouses, and then anyone that's providing a service to the account, which could be an advisor, a CPA, your custodian, for example, and as well, any companies or entities that are majority owned by disqualified persons or a combination of. So an example of an entity majority owned by disqualified persons could be a business that is owned by your parents, if they own 100% of it, or if there's a business that you own half of, it would still be considered disqualified from your self-directed HSA. And what that means is that you wouldn't be able to do any investments directly transacting with those people or those entities. So it's designed to be more of a long-term strategy to invest for wealth building, and not necessarily designed to be directly benefiting you personally through the investment or any of those disqualified people benefiting from the investment. So there are a couple of different types of prohibited transactions defined here. An example of the per se prohibited transaction would be you try to use your self-directed HSA to purchase a property, a real estate property that you own. Because you own it and you're disqualified from your account, you can't sell it to your HSA. Your HSA could certainly purchase a property from any other seller that is not considered a disqualified person, and that would be no problem. An extension of credit prohibited transaction happens when money is lended to a disqualified person, or any disqualified person provides some sort of guarantee on a loan. So if the HSA is going to be lending money, maybe you want to be more passive in nature and you want to act as a private lender, and you use your HSA to lend to someone that you know or lend to a business that you know, and they're going to pay you back. You just can't guarantee that loan, and you also can't have any disqualified people guarantee that loan. Self-dealing is a little bit more of a gray area. This might not be as blatantly prohibited as the other two examples that I mentioned, but it might be a situation where someone is somehow benefiting from the investment, even though they might not be sitting at the table doing the transaction. They're somewhere in the background getting some sort of benefit. So an example of this might be you use your self-directed HSA, you invest in a company that is not owned by any disqualified people, but your spouse works there and provides consulting and gets compensated by the company. Because your spouse is a disqualified person and they're receiving a benefit that is tied to your IRA's, your HSA's investment in this case, then that would be a prohibited transaction. So this may seem like a lot to take in and sift through. The role of a custodian is to be your guide through this process and to provide thorough education about the limits, and then also to review any particular transaction to determine whether it is feasible to be held in the self-directed HSA. So if you're at a point where you have an investment in mind and you're like, hey, I'm not really sure, can I do this with my HSA? You can certainly contact a custodian, and then they can, help you kind of make that determination. And depending on the complexity of the transaction, there may be cases where it makes sense for you to consult with a specific type of attorney as well for legal advice. If there are a lot of parties involved, if there's a large sum of money involved, just depending on what it is that you're looking to do, there's certainly ways to sift through that and figure that out. Okay. So usually the next question becomes, if I wanted to do this, what are the mechanics of setting it up? So the first step in the process is establishing a new self-directed HSA, whether you've never set one up or you have one that's held elsewhere, but they can't hold these types of investments that we're talking about, like the real estate and the private equity, et cetera. So if you wanted to open a second one, you could. In order to do that, you would just fill out an application. Everything is done electronically through DocuSign, and then you would just have to provide proof of HSA eligibility. And then once that application is processed, it takes about 1 to 2 days to get the account open. You would then determine how you're going to fund your HSA through one of the methods that we talked about earlier. So if you have an existing HSA, we could request some or all of those funds be transferred to your new self-directed one. Or if you don't have one or you don't want to use those funds and you want to make a new contribution to your new HSA out of your own pocket, which again is tax deductible, you can make a contribution. And then, of course, if you already owned alternative assets in a different type of HSA and you just wanted to switch custodians, you can do that as well. And then lastly, once your account's open and funded, you're going to identify an investment that you want to do. You're going to work with the custodian's operations team to submit required documentation and also provide them sort of a direction of investment type letter, which is basically going to just tell them what instructions you want them to carry out to do your investment. How much money are you sending? Where are you sending it? How do you want it sent? And again, because the custodian isn't fiduciary, they're not going to make any of those decisions on your behalf. They're just simply going to carry out the instructions that you provide. As long as we know that they're within IRS regulations, we would do that, do a review of that documentation for compliance, and then process the transactions. And then, of course, it's a closed loop system for you to be able to maintain all those tax advantages, the triple advantage that we talked about. So the funds go out to your investment, whatever your investment pays back, whether it's in the form of rental income, interest and principal if you were loaning, if you invested in a private company and you're getting dividends, whatever it might be, those payments go back directly to the custodian and they get deposited directly back into your HSA. So that's where they remain tax protected and then they grow tax free. Of course, you can take them out for qualified medical expenses with no taxable consequence, but you can also keep them in there and grow them as long as you want. A lot of people say, if you don't need the money for the medical expenses in your working years, a lot of people might say that they want to save them and keep them in there and wait until they retire, and then they anticipate needing more for healthcare coverage or healthcare expenses. So there are a lot of different strategies that you can, that you can pursue. But just knowing that you have this option with the self-directed angle and you have the triple tax advantage, And just having this additional education opens up a lot of doors to consider other options as well. So this was relatively quick. I know there wasn't a whole lot to dive into, but because we are very passionate about educating, we wanted to make sure that we did in fact include this, and especially as we're getting toward the end of the year, people are starting to, think about plans for next year financially, and otherwise. And we are seeing a lot of movements in the job market. A lot of people are leaving jobs, starting new ones. So it's a great time to start thinking about benefits and what you might want to do differently. So with that, if you do have any other questions, feel free to contact us. You can check out the website. There's a ton of information there as well. You can email my team at newaccounts@nextgeneration. You can call the office and speak to a live person immediately. And with that, I'm going to take a look and see if we have any questions. I think we might have one. Let's see. Yes, we do have one question. Is this money that is deposited before or after taxes? So it's before tax, but if you're distributing, if you're taking a distribution for qualified medical expenses, you still don't have to pay tax on the back end. So that's one of the nice things about it, is your contributions are tax deductible, so they're technically pre-tax, but your earnings grow tax-free in the HSA, and if you take the money out of the HSA for qualified medical, it's still tax-free. So essentially, you really never pay tax on it. If you are over the age of 65 and you take the money out for expenses other than medical, you will pay ordinary income tax on those withdrawals, but it is all pre-tax. You're very welcome. It is a pretty powerful tool that a lot of people don't know about. So with that, I think those are all the questions that I see. Again, this recording will be distributed to everyone, whether or not you attended. And we hope to be speaking with you soon. Hope you learned something today, and enjoy the rest of your day. Take care.